So here we go. So section 3 is strategies for saving and investing. Section 1, we looked at kind of the reasons, and then yesterday was the principles and the risks that come with it. And then now we're going to talk about different strategies. So systematic saving is a strategy that involves regularly setting aside cash that can be used to achieve goals. So some people will have it set up every pay period. Maybe you get paid every 2 weeks, every month, every week. And if you have, you can set it up so that your bank does it automatically just with your online banking. You don't even have to go in anywhere. I mean, it could be whatever amount you are comfortable with. And if you have it set up kind of immediately, then you won't even really miss the money. Rather than if you do it on your own, you might kind of think you need that money. But it could be, $5, $20, $100, depending on how much you make and how often you're being paid. You can just have it directly go into a savings account. And systematic investing is very similar. It's a strategy that involves a planned approach to making investments on a regular basis. So same thing, kind of maybe on the first of the month or whatever day, or every 3 months, whatever your regular basis is, you kind of put that money into your investments. So a systematic saving and investing plan, those are both designed for the long term, and kind of seeing the overall picture rather than right now and short term. So sometimes you have to have your investments, for 10 or 20 years to kind of get the returns you want on them. So it's not something that's going to happen overnight. You're not going to get any instant gratification here on most of what we're talking about. Investment tracking is a technique for making investment choices by following the prices of stocks and other investments over time. So you kind of, what that would be is you look at whatever stocks you are considering, and there should be multiple, and then you can track them, every day, every week, every month, depending on how long you track them for, and look for trends and see which one fits your what you're looking for, I guess I should say. And oftentimes you're going to want to put that in a graph, and we'll see that on the next slide. It makes it easier to follow rather than just dollar amounts listed. Market timing is buying and selling stocks based on what the market is expected to do. So there are analysts and brokers that's their job. They kind of make predictions about what they're expecting to happen, and they can be wrong. But again, oftentimes they know what they're talking about, so they make those predictions so you can time what you're interested in buying. So this next slide, this is a stock trend line, and this is what I was talking about. This one is set up on the x-axis in years. And so you can see after year 1, it was $50, and year 12 is $65. But this is why we look at the kind of overall picture. If you just kind of zoom in at years 4 and 5, it doesn't look very good for you. You lose money. But overall, you can see that it's going up. And again, you can set up something like this so it does it daily. It can be set up, once a week, once a month. This one is yearly. But it makes it easy to give you a snapshot of what's going on. And then dollar cost averaging is investing the same amount of money on a regular basis, regardless of market conditions. So it could be, every month you put $100 into some stocks. It doesn't matter how the market's doing. It could be going up or down, and you're going to put that same amount of money in. So these are just different ways to approach investing. So you can kind of have that systematic, and then you can do the investment tracking, paying attention to what's going on, market timing, trying to make predictions, or dollar cost averaging just the same amount all the time. Which dollar cost averaging is what we're going to look at tomorrow. And then how can you reduce investment risk is by diversifying your investments. So diversification is holding a variety of investments for the purpose of reducing overall risks. So what you want to do is build a portfolio, which is a collection of investments. So the idea is you have, and I think the next slide will have an image for us. You want a portfolio that's diverse, has different types of investments. So you want to start at the bottom with your foundation, which those are going to be the more secure investments. They're less risky. Things like your savings accounts that are FDIC insured, CDs and treasury bills. Those are, they're the most secure and they take the least risks, but you're also going to typically you have less potential for growth on those. Then conservative investments, mutual funds, bonds, either government or corporate. So those again are a little bit more risky, but they're still not high risk. A mutual fund is a professionally managed collection of stocks and investments. So what it is you put your money in some person or company, they kind of take your money and other people's money and split it up into different investments. And then growth investments, which stocks and real estate, and then speculative investments. So you want to be diverse, but again, you want to start out strong so that you have that money in case you lose some of these higher risk options. And then how to maximize your investment return. So the financial market is any place where investments are bought and sold. There's always going to be times of growth and decline, just like with our economy. Different people have different perspectives on when you should buy. And I know you guys talked about bull markets and bear markets with Mrs. Morgan. I don't know how much you went into them. We're not really going to get into them, but a bull market is rising stock prices and overall optimism, and a bear market is decreasing stock prices and investor pessimism. So like the financial market, everyone approaches it differently. Some people, when there's a bull market and optimism, that's when they like to buy. Things are looking good. Some people like to buy in a bear market, even though overall it's not looking good. You're getting lower prices because it's declining. So again, everyone just approaches it differently depending on how you feel about it and the risks you're willing to take. But we'll get a lot more into that in chapter 11. So